Hey guys, imagine this. I've been glued to my screen for exactly 2 hours and 17 minutes. I saw the market open, I watched the candles form, I followed every tiny price move, and what I'm about to tell you isn't just a guess or some idea. It's a real pattern that showed up 3 times before in recent market history. Every single time it happened, the price shot up like crazy within 72 hours. This isn't fake excitement. This isn't just to get clicks. This is real technical stuff happening live right now. If you missed the first 2 hours of this jump, you're about to see how the people betting against it, the bears, got caught in a trap. They were hoping for a drop that will never happen. The chart opened right at 8 p.m. Eastern. Not 8:01, not 7:59. Exactly 8 p.m. when Sunday night trading started for futures. Friday closed at $7,642. Tonight, it opened at $80.18. That's a $3.76 gap up. Not a mistake, not a glitch. That's a 4.93% jump, with nothing in between. The chart has blank space there, a big empty spot. For the last 2 hours and 17 minutes, every trader who was short betting the price would fall has been hoping, praying, doing anything for the price to drop back to fill that gap at $76. It hasn't happened. It's not going to happen. I'm going to explain in super clear detail why that gap stays open forever, what it really means, and why anyone sitting on the side waiting for a cheaper price is about to watch this thing fly to $90 without getting in. But first, you gotta know something about the YouTube algorithm that decides if people see this video. YouTube doesn't want you to watch stuff like this. They don't like technical talk that goes against the usual story. They don't want regular people getting fresh info right away. As soon as I post this, the video goes into a quiet zone. It only shows to maybe 10% of my subscribers if I'm lucky. The only way to push it out to more people is if you hit like right now, not later, not after you see if I'm correct. Right now, every like tells the algorithm, this isn't weird stuff or fake news. This is real info people need. So do it. Hit that like hard, fight back against the hiding. I'm not being polite here. This info lasts only hours, not days. Come on, let's move. Let's look at the chart. The gap started at $80.18. In the first 15 minutes, it dipped a tiny bit to $79.85. That was the lowest point. That was the test. The market gave the bears one shot to get out at $79.85, which is still way above Friday's close. They didn't take it. Why? They were holding out for $76. They wanted the gap to fill like usual. They expected the normal gap rules to work. But this isn't a normal gap. This is a runaway gap. This is a measuring gap. This is a sign the move keeps going. If you don't get the difference, you're about to learn it the hard way, and it might cost you a lot. Let me break it down simple. There are 4 kinds of gaps in charts. Not 2, not just it fills or it doesn't. 4 different types with different results. First, common gap. Just random noise from low trading overnight. It always fills in a day or two. Second, breakaway gap. Happens when something breaks out of a sideways range with strong energy. It might fill a little, but usually stays because minds have changed. Third, exhaustion gap shows up at the end of a big run when the last buyers jump in before it tops. It fills fast and hard. It's a trap. Fourth, runaway gap, also called measuring gap, the one we're seeing now. It happens in the middle of a huge upward move when there are suddenly no sellers left. The price just jumps. It doesn't fill. It doesn't come back. It speeds up even more. How do you tell which one it is? Look at volume, what time it is, and the bigger picture. The opening candle had 47,000 contracts in the first 60 seconds. That's not random noise. That's big players jumping in. The time, Sunday night, 8 p.m. Eastern, is when Asia starts trading. Not New York or London, Shanghai, Hong Kong, Singapore are waking up and saying no, waiting for a drop. The picture, last week it closed at $76 after slowly climbing from $70 over 10 days. That's a $6 rise. A runaway gap in the middle usually means the same distance more ahead. From $70 to $76 gap would aim for $82, but we gapped at $80, so now it points to at least $90. Think about that for a sec. The market is showing right now, with its moves, that $90 is the next big number people will think about. Not next week or month. This week, maybe tomorrow. The folks saying, "I'll wait for the pullback," are the same ones who said it at $70. Same at $65. They'll say it at $95 too. By the time they finally buy at $115 or whatever, the big move is done and they sat in cash the whole time. Now let's talk about how the trapped shorts feel. This matters. It's what powers the rocket up. Every short is really a promise to buy later. You borrow the thing, sell it, then buy it back someday. The guy who shorted at $76 on Friday thought it was too high and would drop to $72. Now he sees $80 open and he's down $4 already. He's not freaking out yet. He still thinks the gap will fill. He thinks prices always come back to average. So he waits. Price stays at $80, then $80.50, then $81. Now he's down $5, starting to sweat. He's checking his account, wondering how high before his broker calls for more money or forces him out. When he finally gives up and covers, he turns into a buyer at market price. No waiting, no haggling, just buy now to survive. When lots of them do it together, that's a short squeeze. Price goes straight up. Weird candles. Gaps that stay. Runaway gaps. Let me show you. It happened before. Same thing every time. 3 real examples, so you see the pattern. First, silver in April 2011. It climbed slow from $30 to $40 over 6 weeks. Then Sunday night, April 17th, gapped from $42 to $45. Bears waited for fill. Never happened. Silver hit $49.80 in 4 days. Gap held as support. Everyone waiting missed it all. Second, gold August 2020, climbing from $1,800 to $1,900. Sunday night August 2nd, gapped $1,920 to $1,975, a $55 jump. Bears called it overbought, waited for drop. Never came. Gold hit $2,070 in a week. Gap became floor. Sellers got crushed. Third, crude oil March 2022, rallying from $90 to $110. Sunday, March 6th, gapped $115 to $123. Huge shorts. Media yelling bubble. Gap never filled. Crude hit $130 in 48 hours. Bears waiting for $115 got forced out at $128. 3 runaway gaps. 3 big upward explosions. 0 fills. All on Sunday nights, with thin trading and Asia pushing. See it? Not random. It's how markets work when Western markets sleep and Eastern buyers take over. Let's do the numbers live. Move started at $70, now at $80. That's $10 up. Runaway gaps often hit at the halfway point. So another $10 to go. $80 plus $10 equals $90. Or be safe, say Fibonacci 1.618 times the first $6 move. $6 takes 1.618, $9.70. Add to $80 equals $89.70. Rounds to $90. Every way you look at it, math, history, patterns, says $90. We're at $81 after 2 hours, and people still ask if they should wait for a dip. Waiting costs you. Sitting in cash means betting the price comes back to you. Betting against the gap, hoping for another shot at $76 or $78. But every minute waiting, you're not gaining. If it hits $85 tomorrow and you buy then, you missed $4. To $90 Tuesday, missed $9. To $100 later, you'll tell everyone, I saw it at $80 but waited for pullback forever. On the big money side, they're not waiting for dips. They build slow over weeks with bots that don't spike price. They know gaps coming because they help make them by pulling sell orders away. Market isn't simple buyers meet sellers. It's pools of orders controlled by big makers. To gap up, they remove sells between levels. Sunday open, buys hit empty space from $76 to $80. Gap looks fake but real results. Bears trapped, forced to buy back, runaway starts. Same story every time. Institutions buy low when retail scared. Gap to shake weak hands, trap shorts, then squeeze carries to $90, $110, while they sell to late buyers in panic. I need your help now. Go to comments, tell me what you see. Watching live? Bought the gap or waiting? Short? Your data helps me. I see price, volume, orders, but not feelings or regret. You're my live sensor. Comment your position. Plan, in or out. Is everyone still doubting or is excitement building? Do it now. The bad guy here is the big trading algorithms, not little ones. The fast institutional ones doing billions per second. They hunt volatility for profit by making wild swings that trick regular traders to buy high, sell low. They ignore real stuff like shortages or China buying. They hunt order clusters, stops or limits, hit them, grab liquidity, reverse called liquidity sweep. But in runaway gap, algo loses power. Gap is empty, no orders there. When it tries to go back down, nothing to grab. It stops, turns, chases up where new buys are. That's why gaps like this don't fill. No reason for big players to fill them. Only trapped retail shorts want it, and they don't run price. They're just fuel for institutions cashing out higher. Now the bigger world picture. This isn't just lines on chart. It's real supply shock plus futures running low on actual stuff to deliver. Paper price and real metal price splitting. COMEX and LBMA in trouble. Banks short can't deliver if everyone asks. When that hits news force majeure, bankruptcies, the $80 gap will seem tiny. China importing huge amounts monthly, up 40 to 60% some months. Taking real metal from West to their vaults forever. Not paper bets. Physical. Every ton gone means less for COMEX delivery. Open interest 190,000 contracts squares 5,000 hours, 950 million hours paper. Registered metal approximately 40 million hours, 23 paper to real. If 5% ask for delivery, COMEX breaks, 10%, whole system crashes. Price doesn't stop at $90, could go $200, $500, whatever forces longs away, since no metal. This math broke things before. London Gold Pool 1968, Hunt Brothers 1980, Palladium 2000. History rhymes, shortage, squeeze, emergency rules. Back to 1933. FDR banned private gold ownership. Took it at $20.67. Revalued to $35, 69% dollar drop overnight. Paper holders wrecked. Physical holders got new price. Nothing holders got nothing. Why? Banks broke, too much printing, no real gold backing. Confiscate, revalue, save system. Legal steal, but worked. Smart ones bought early, kept wealth. 1971. Nixon closed gold window. No more foreign redemptions. Dollar pure paper. Gold then $35 to $850 in 9 years. 24x. Gold owners rich. Dollar trusters hurt by inflation. Patent system breaks. Rules change. Confiscate, devalue, print. Hard asset holders survive. Paper holders lose. We're early and same thing now. Huge debt. Deficits. Fed printing. Banks shaky. Question. Confiscate before or after big price jump? Right now, price at $81.35. Never went below $80 since open. Volume up. Spread wider. Big buys coming in. Indicators all say breakout continuing. Moving averages lined up. MACD crossing up. RSI 60s, not too high in bull run. Bands expanding. Price on top band, classic trend. Still comments waiting for $75, $70, $60. They'll wait forever. Watch to $100, $150. Saying too expensive each time. That's anchoring stuck on old price. Retail loses that way. Pros chase momentum. Buy breakouts, make money while others freeze. I'm not saying buy, not your advisor, not licensed, just a guy reading charts. You decide, you risk. But I'm showing what I see. Pattern with 100% history success. 3 cases, 3 big wins, no fails. 4th happening live. Ignore or wait your call. But if at $90 in days regretting, don't blame me. I'm saying now gap not filling, breakout real. $90 mini now, risk reward great, setup perfect, chance live. If wrong, gap fills, drops to $76, down $5 from $81, 6.2%. If right to $90, up $9, 11.1%, ratio like 1.8. Even 50% win rate profitable. But history, 100%. Stop at $79 conservative, $77 aggressive, let run. I'm not wrong. 15 years watching, studied every big move since 2008. Patterns, tests, wins/losses. Lesson, when textbook signal plus history plus math, don't fight. Take it, trust, Execute. Waiters, for sure thing never win. News confirmers late. CNBC safety seekers are exit for early buyers. Price is truth. Chart says now gap holds. Target $90. Subscribe now. If not, don't know how long allowed here. Strikes, suppression possible. This info real time, unique. Media won't say runaway gaps. Structure, inventory. They push bank-friendly stories. Same banks losing big short. Subscribe. Notifications on. Next move, $90 break. Delivery issues, force majeure. You hear first. Not days late. Hit subscribe, bell, like to beat algo. Comment position. If value here independent from mainstream, super thanks. Or join member. Not required. Voluntary. But don't ignore chart gap signal. Market talking loud. One message.